Hello everyone, it's Eric here, and I wanted to give you an update on my dividend portfolio. I've hit a few milestones that I've been celebrating recently, and I wanted to share them with you. My dividend growth portfolio has hit the $16,000 mark. I've crossed $2,000 in gain with a 30% return, and I've earned over $150 in dividends, with $48.47 being in the past month alone. I also recently set a new record for the most I was paid out on a single day in dividends. On April 15th, I was paid by 10 different companies dividends totaling over $28. And those companies that paid me were U.S. Bank, $1.10, Store Capital with $11.27, Stag Industrial with 50 cents, Realty Income Corp with $2.40, Leggett & Platt with 87 cents, Federal Realty Investment Trust with $6.17, Essex Property Trust with $4.51, Ecolab with 5 cents, Cincinnati Financial Corp with 27 cents, and Cardinal Health with $1.60. If we look here at my dividend payout tracker, that single day paid me out more dividends than every month except March. So the snowball is growing, it's growing quickly, and it's very rewarding to watch my dividends go up month over month. While we're here, I'll go ahead and show you my dividend tracker spreadsheet. I take the payout that I get every month from my M1 account. I go to View Account Settings, Documents, and then I click on the brokerage statements, and that has the information. So I enter that number here. I enter the portfolio value at the end of the month. That calculates my month-over-month growth rate as compared to my monthly average income. And then I calculate my annualized income. And I plot those out here, my monthly dividend payouts. As you can see, they spike every few months. Then I have my annualized income that takes my average monthly income and annualizes it. I plot my portfolio value, and then I plot 15 years of estimated future income with dividends reinvested. I've also added some new stocks to my portfolio, to the slices in my dividend growth portfolio. I haven't purchased them all through auto invest yet, so I am currently at 95 positions, up from 80 something earlier. But if we look here at the spreadsheet, I have highlighted the ones I've added. So I haven't changed real estate at all. For utilities, I've added American States Water and Next Era Energy. Telecom has stayed the same. For healthcare, I added Stryker. Finance has stayed the same. Industrials has stayed the same. Consumer staples, I haven't made any additions to. Neither have I made any additions to consumer discretionary. For technology, I added International Business Machines and Jack Henry and Associates. And for energy, I've added Enbridge, National Fuel Gas, and NACCO Industries. And for materials, I added Air Products and Chemicals, RPM International, HB Fueler, Lind, and Nucor. And so when Auto Invest goes and finally purchases all of these, I will have a total of 98 stocks in my dividend growth portfolio. which is a little high, but I am investing with the goal of creating a dividend ETF like Pi in M1. So I've taken the baseline of dividend aristocrats. There's 66 of those. I handpicked most of those, added a few other companies, and now I've gone and added dividend champions, which are non-S&P 500 companies that have increased their dividends for 25 years or more. So I think this will give me a very diverse set of dividend stocks across all the industries, and it's one that I don't have to worry about as much. It's kind of like Noble with a few other high quality dividend aristocrats in it and dividend champions. It's really a dividend champion ETF that I've created, and M1 allows me to have a total of 100 stocks. I'm not planning on maxing it out, and I don't know if I will keep all of these. As I've mentioned before, Viatris I didn't buy. It spun off from Pfizer. I don't know if I will keep it. If Disney doesn't restore their dividend, I'm thinking about selling it out of this portfolio. And I'm also thinking about adding an ETF or two. But for now, I think that my portfolio is set. I've added the companies I wanted to. I don't expect any other major changes in the future except for mergers and acquisitions and spin-offs, and then I'll adjust accordingly. But unless any of these companies reduce their dividends, I'm not going to sell any of them, and my portfolio is finally as is. So I wanted to share a quick article with you guys. Here's an article from the Motley Fool entitled, "A Stock Market Crash May Be Close. 4 Must-Know Metrics That'll Make You a Smarter Investor." I'm not really concerned about the metrics that they talk about in this article, but I do want to point out this one part of the article that I read. The case for a stock market crash is growing. Arguably, the biggest concern for equities at the moment is valuation. Despite ideal conditions for growth stocks, historically low lending rates, dovish monetary policy, and free-flowing stimulus spending from Washington, valuations eventually always matter. As of this past Monday, April 12th, the S&P 500 Triller price-to-earnings ratio topped 37, which is well over double its historic annual average of 16.81. The Triller PE ratio, also known as the Cyclical Adjusted PE ratio, or CAPE, is based on average inflation-adjusted earnings from the previous 10 years. Why is this important? There have only been 5 instances over the past 150 years where the S&P 500 Triller PE ratio surpassed and held above the 30 level during a sustained bull market. In the previous 4 instances, not counting the current bull market event, the S&P 500 eventually retraced by a minimum of 20%. And so what is this article saying? It's saying that right now, the PE ratio of the stock market is extremely high, probably overvalued. It's much higher than its historical average, which infers that the market is overvalued, and that eventually, when it gets so overvalued, there will be a market crash of a minimum of 20%. And so it might not be today, it might not be next week, it might not be a month from now, but eventually all bull markets come to an end. And this bull market is rather hot. Stocks have gone up tremendously since the crash in 2020, and maybe they've gone up too much. They seem to have become dislocated from the earnings, from the economic conditions underlying the stock market, and so it's pretty hot, and the PE ratio is too high, and that leads me to believe that the market is currently overvalued. Fortunately for dividend investors, when the market crashes, it's an opportunity. It's a buying opportunity to get more stocks at lower prices with higher dividend yields. So if the market does crash again, it would just be a fire sale on dividend stocks.